Our video today is going to be about price action, especially liquidity. Voltaire said, short-term price movements can only be explained throughout liquidity. Concretely, price is only moving to generate liquidity. In other terms, to either make more participants engaged in the market or make others leave it. Because leaving the market is also a form of engagement. But before explaining liquidity concepts, we are going to start with the basic reminder. At the first glance, when we talk about price, it has two components, the bid and the ask. The bid is the highest price at which buyers are willing to engage in the market. When it comes to the ask, it is the lowest price at which sellers are willing to sell an instrument. Think about it just like a market of auctions. And what makes actually the price move is the attractiveness and the relevance of the level of either the bid or the ask. If a certain level is more appealing and attractive to buyers, then the variation of the demand will be higher than the variation of supply. And when I talk about variation, it doesn't need to be positive. For instance, in this scenario, the variation of demand can be below zero. However, the variation of supply needs to be even lower. And as a result, both the bid and the ask will go up until the ask becomes more relevant to sellers. In the opposite scenario, when the ask is more attractive and appealing to sellers, we'll automatically have the variation of supply being higher than the variation of demand in the market, and the price will eventually go down until again, the bid becomes more attractive to buyers. It's a simple dynamic, but a lot of people choose to disregard it. And when we talk about variations, it is simply the value of either supply or demand right now minus the previous value of one of them divided by this previous value. More simply, it is only a comparison between the new value and the old value. So it has nothing to do with volumes or the number of participants. It is only about the change regarding a point of reference in the past. So if we apply the same reasoning to explain price action, we can conclude that the price can either move in consolidation or in momentum. If the difference between the variation of supply and the variation of demand is low or equal to zero, then the price will consolidate. Inversely, when the difference between the two variations is high, that will lead the price to create momentum. But when we talk about momentum, it simply means that the price is moving either way. It doesn't necessarily mean that the market is inefficient in that case. It simply means that we have an imbalance between the variation of supply and the variation of demand. Eventually, this imbalance can lead to inefficiency when this imbalance is leading to a volatility in a short period of time. When we talk about efficiencies in the context of price action, it has nothing to do with the market efficiency hypothesis and price movements on the long term. It simply refers to the inability of the price to be delivered efficiently to either buyers or sellers because some of them would not be able to enter the market. At this stage, prior to delving more into inefficiencies, it would be more relevant for us to start with a basic classification. So when we talk about demand, it is simply representing a group of people willing to buy an asset. And vice versa, when we talk about supply, it is simply a group of people willing to sell a certain asset. But at the same time, you always have two types of participants, those who are willing to be engaged in the market and others who are willing to exit the market. So when we talk about demand, it's not only about people who are willing to buy an asset to own it, but also others who went short on an asset and need to buy it back to offset their position and exit the market. When it comes to supply, it's the sum of people who are willing to sell something that they don't own and those who will sell something that they own. So if we analyze the market considering those four groups of people, we can conclude that liquidity exists in four main areas. So again, let's consider supply and demand. As we have said previously, once we have a high volatility in the marketplace resulting from an imbalance, this can occur in a short amount of time or in an extended period. Concretely, in the scenario of continuation, if we have a volatility of 1% on the daily, but 60% of this volatility occurred on a specific hour, then an inefficiency will certainly be formed during this hour. Nonetheless, if the distribution of this volatility was relatively equal throughout the hours of the day, there is a high chance of the price being delivered efficiently. Furthermore, inefficiencies can be formed in different manners. If you looked into ICT concepts, you can observe that Michael mentioned a lot of PD arrays. Some of them are inefficiencies, while others are just price signatures. Concretely, inefficiencies are going to be observed within price in different patterns. The first one is the ICT fair value gap. The fair value gap is so easy to observe within price. It is simply the difference between low of the previous candle and the height of the next one when it's bearish. And it's the difference between the height of the previous candle and the low of the next one if it's bullish. Typically, if we have a bullish fair value gap, we expect the price to form a price signature when it returns to it and then keep moving up. However, it's not always the case because the price can simply return to a fair value gap and doesn't consider it at all. It's not about the efficiency itself, but rather about the context of higher time frames, the time at which the signature occurs, and what is driving the market on the long term. So in a nutshell, if the price retraces to a bullish or bearish fair value gap, it is supposed to keep moving in the same direction as the nature of this fair value gap, but sometimes it won't. It doesn't mean that the concept of inefficiencies is useless, it simply means that it is limited and dependent on other concepts. The second type of inefficiencies is the ICT rejection blocks, or simply wicks. These patterns are also super easy to observe, but the problem people tend to focus on wicks are that they're located on the extremes of price action. As a result, the right way of utilizing rejection blocks is also by considering those who are formed within a price leg. So just as fair value gaps, you have two types of wicks, or rather rejection blocks. First of all, you have bearish rejection blocks, which are the difference between the high and the opening price of a candle if it's a bearish candle. If this candle is bullish, then the rejection block is the difference between the high and the closing price. When we talk about bullish rejection blocks, it's the difference between the low of the candle and its opening price if this candle is bullish. However, if the candle where the rejection block is formed is bearish, then the rejection block is equal to the difference between the low of the candle and its closing price. The third type of inefficiency is gaps, and when we talk about gaps, it is simply a pattern that occurs when the closing price of a candle is different from the opening price of the next one. In the context of forex, gaps usually form in the weekends when we have some events leading to a discontinuation of price action between the closing price on Friday and the opening price on Sunday. However, when we talk about forex futures, it can happen on a daily basis since the markets of futures have different trading hours. It's the same case for equity and bonds because those markets can't be traded 24 hours. And the same reasoning for fair value gaps and rejection blocks apply to gaps because, after all, it's just an imbalance that usually happens when the market is closed. And we expect some kind of reaction when the price goes back to it. Finally, the last type of inefficiencies are volume imbalances, which are a combination of rejection blocks and gaps. It usually forms when we have a gap and the price retraces to rebalance it immediately. But after doing so, it moves quickly. So when you think about it, it is a failure to rebalance an inefficiency. Concretely, when you see a volume imbalance, always move to lower time frames and you will notice that the price has rebalanced it and moved quickly. So it's not a pattern by itself, but rather a combination of two patterns. If you are a beginner who tries to go through price action and internalize the concept of inefficiencies properly, it's going to be a bit challenging because what makes inefficiencies powerful isn't actually the existence of these patterns, but rather how the price will go back through them and from price signatures. Moreover, regardless of the inefficiencies that we can observe on a specific price action, it is always super important to observe how different inefficiencies in different time frames coexist together and make the price print itself. For instance, if you have an inefficiency on a high time frame, like the daily, it might be interesting for you to go to the lower time frames and to find points of interest, for example, on the 4 hours or the hourly chart. But when we have opposite inefficiencies, it is always a better idea to trust the ones formed on high time frames, but to also consider the ones that form on lower time frames. For example, if the price forms a daily fair value gap, and within this fair value gap we can observe an hourly rejection block, that's going to be our point of interest, and if the price forms a price signature on it, that would be our signal. Then, hypothetically, we will enter the market. If the price goes in your favor and you're holding a winning position, when the price reaches an opposite inefficiency, we can expect some kind of reaction. It doesn't necessarily mean that the price will reverse and will take us out, but at least it can retrace. With that in mind, inefficiencies serve as points of interest to enter the market, but also as areas where to take profits. Previously, when we talked about supply and demand, also including people who are willing to exit the market, then it may also be interesting to understand where people exit the market because these areas are also zones of liquidity. I don't know about you, but I have studied a lot of books about technical analysis, and initially when I started to learn about trading, the first concepts I was taught are supports and resistance. Support and resistance are simply some psychological levels that were respected in the past, and in theory, it shouldn't be broken, meaning that the price should never go above a support or below a resistance. Then, logically from this perspective, by simply placing the stop loss below a support or above a resistance, we are taking risk-free setups. And that's what the majority of retail traders are doing. And since the price cares only about being attractive and making participants engaged, this will eventually go to reach support and resistance. The problem with support and resistance is simply that these levels are perceived differently. As we have established, participants engage in the marketplace using different approaches and for different horizons. For instance, if you are a scalper or a day trader, support might be the previous day's low, but for a swing trade, his support might be the low formed prior to the change of trend or the previous week's low. From now on, just like Michael, we're going to call a support sell-side liquidity and a resistance buy-side liquidity. Think about it. If the price has to go below a certain resistance and take out the buyers, those participants will need to sell back their positions to exit the market. And that's why it's a sell-side liquidity. The same reasoning applies to the buy-side liquidity. The most obvious and easy buy-side and sell-side liquidity to identify are marked highs or lows, which are simply swing highs or swing lows formed prior to a change in the trend. The price might go there just to take out people and form a price signature if you do zoom in to a larger time frame. The second type of support and resistance are relative equal highs or lows, and these are areas of liquidity because the price has struggled in the past for multiple times to go beyond a specific level. And in the retail's mind, it is simply seen as a strong support or resistance because each time the price tries to break out, it fails. And I don't want to confuse you that with the price moving in the consolidation and slightly taking out a high or low, it needs to have at least a different type of price action. Finally, you should also focus on the high and the low of the previous month, the previous week, and the previous day because those are also areas of liquidity. You don't need to drop it into sessions and see the highs and the lows for each session, especially if you're a beginner, because that will only make it more complicated. So to summarize this video, we can say that areas of liquidity are simply zones where the price can react, but it hasn't done so. So the goal is not actually to enter the market each time the price reaches an inefficiency or a liquidity side, but rather just to be able to identify them, and throughout the backtesting videos, we will observe how the price prints itself by reacting to different liquidity areas with respect to time frames.